everyone, and welcome to another live panel here at RW Week. I'm Polly Speak, strategic advisor and coordinator here, and it's great to have you all with us today. Our topic is big one: who owns the tokenized economy, platforms, protocols, governments, and tokenization is moving from an interesting idea to something that could completely change how financial markets work. So this conversation could not be more relevant. And we have an amazing group of guests with different perspectives. And I'm looking forward to hearing where they agree, where they disagree, and maybe where they surprise us. Joining me today, we have Rachel Chia, co founder and CEO of Slay Capital. We have Yarden Nui, partner at DLT Law, and we have Martin Pullen, head of digital investments at Wealth. Let's jump straight to the discussion and see who might really shape the future of tokenized economy. But first of all, I think we can do a round of introductions here. So, dear speakers, dear guests, feel free to share your stories, how you end up in Web3, what is your background, how you end up building what you're building right now. Ladies first, Rachel. Feel free
Sure.
to go.
Thank you for having me. Very pleased to be here and very excited about this conversation that we're going to have. I actually started my career as a derivatives lawyer in London, doing structured products for quite a long time. So a lot of the kind of RWA tokenization conversation actually is very relevant to my experience as a lawyer, as a derivatives and structured products lawyer. After lawyering, I ended up becoming a banker where I ran the kind of structured products, equity structured products desk at Merrill's. And then I left and started looking at the blockchain projects. One of the first projects I did was a tokenized art, securitized art, which was the Andy Warhol, and also built a stable coin. Eventually, I ended up as the CEO of SDEX, which is Singapore Digital Asset Exchange, where we delivered over 2 billion in distributed RWA tokenized yielding products. I've left. I've now broken out of SDEX to set up what's called Slay Capital, which is an allocator into RWA yielding products. Slay actually stands for secured liquid alternative yield, and that's the kind of focus that we have at Slay Capital. So that's my introduction.
Wonderful. Well, I really enjoy hearing stories like yours, Rachel, because I think that they show that Web3 is not only built by software engineers, right? You started in law, moved into investment banking, then found your way into blockchain through tokenized art, which is quite unusual journey, I would say. And I also like that your experience connects with traditional finance with digital assets, because that's exactly what this industry needs right now. And it reminds people that innovation often comes from combining different worlds, not choosing one over the other. Yarden, feel free to share your experience as well. Was you always in legal sphere, or there's
That's the
another?
only thing. That's the only thing I know how to do. Thanks, Polly. I started my journey as a lawyer in 2017 and got in by complete accident. Just met a guy that I liked him, he liked me, we wanted to work together. I said, I don't know the first thing about like what you're talking about. And he was super passionate about starting a crypto law practice. I joined him. We started that at out of Tel Aviv, Israel's largest law firm, and we were one of the first dedicated blockchain practices in a law firm globally back in the day. That was right in time for the ICO boom and everything that happened late 2017, 2018, and really I never looked back, and I wouldn't change any single thing. I love this industry. We've been dealing with RWA is a new like term, right? Back in 2019, we called them securities tokens. And there was a big discussion about where, like a very similar discussion to this, like what's going to happen? Can it scale? Can it, can it bring in institutionals? Can it get regulatory approval? And the answer was then in real time, and then more so in retrospect, it was way too early. Now we're early, but not too early. now we're seeing like real shift that, picking up on what we learned in 2019, what we learned from the NFT cycle that followed, and define everything that followed after, and now is the right time.
We're still early, anyways. I think that even in the next 5 years, everyone on Twitter will say, "We will still early. There is a huge potential for us to grow." Well, it's true. It's true. Though, Yaron, I love that perspective because it shows what it means to be early in industry. And back in 2017, many people were still asking, like, "What is blockchain?" While you were already helping build one of the first crypto law practices in Israel, which is very cool. And it's also funny how the names change over time. We used to say digital securities, now everyone says RWAs. I mean, we called song MP3s. Who knows what will be in 10 years? How we're going to call RWAs? I think it's gonna just be a new name, but the system will be the same. But yeah, I think that according to the industry reports, even that the number of tokenized real world assets project has grown rapidly over the last few years. So those early discussions about whether this could scale now feel very different. I think
Hmm.
a little different, but very different. Okay, I am stop speaking. Martin, feel free to introduce yourself as well, and say a few words how you end up in Web3. I know that you're part of different projects right now, building wealth. Yeah, happy to hear your story.
Sure. Thanks for having me. And yeah, for me, my journey started almost 10 years ago in crypto. And of course, everything was very different back then. First, for me, it was just as an investment. I was really curious about what it could be doing for myself. So I started next to what I was doing back then. I was just starting to get really interested in cryptocurrency. So I started investing myself. And at one point, there came a point that I was invested in a seed project. And from there on, actually, I joined the project as from investor to member of the team. And from there on, we actually built within our group. We built this new project, Wealth. So from 10 years back then, just investing, it slowly grew into really building from scratch on and actually a bridge between two worlds, right? Because we are currently in this gap between those two worlds, because I really believe we're still very new, and in 10 years we will be way more advanced. As we think we are still already there or whatever. No, we're still very early. We're still the 1%. Still, only a few percent of total wealth is in cryptocurrencies. And as we are also in traditional finance, we see that the interest is growing, but still very low. And then this is a great opportunity for all of us. So that's why I'm here, in short.
I muted myself. Awesome, Martin. I really like how your journey happened step by step instead all at once. Sometimes that happens as well. So you started as an investor, and then thank God not a lawyer. Otherwise, it would be too boring. The three lawyers at one time, and after you became more involved in the projects themselves, and now you're helping build the future of wealth. So I think that's a great example of how curiosity, especially investment curiosity, can turn into a career if you stay close to the industry. And I like your point about living between two worlds. It stands out because we are between traditional finance and the digital economy. So 10 years in crypto can sometimes feel like 100 years everywhere else. A lot can happen, but in crypto, it feels like probably 20 years because everything is moving incredibly fast here. Maybe not as fast as we want to, but we're slowly going to be there where we want. So I am proposing to start our hot discussion here on the very global topic, I would say. And how do you think, guys, as tokenization scales globally, who ultimately controls issuance, access, and settlement? Who wanna go first? Rachel.
I could go first, and feel free to jump in and disagree with me. So I think that question actually should be unbundled, because there's not going to be one person ultimately controlling issuance, access, and settlement. Those are three different questions. Let's start with the easiest one, which for me is settlement. Settlement will eventually all happen on public protocols. Right, the age of private permission chains are probably going to filter down. A lot of the platforms in Singapore first started their journey with private permission blockchains, but that has a very limiting factor because it ends up being very small siloed pools, and it was done that way because there were several views on the kind of the security around having private permission versus public protocols. But I think where the world is moving now for settlement is permissioned, but on public protocols. So I think that's where it's going to go. Eventually, settlement will just be a commoditized kind of conversation. It will just be a matter of plumbing and infrastructure, and the largest protocols will probably capture most of the kind of settlement that will occur on RWA. So access for me is a question of regulatory controls, right? KYC, AMLs, whitelisting, investor classifications, all those fun things that we have to do to gate the kind of right investors to get onto that purchase these RWA tokens, because at the end of the day, I think most jurisdictions now agree that RWA tokens are securities, and hence they have to be regulated and whitelisted as securities. So I think that's that conversation that's ongoing. Yes, there are different views on whether some RWA tokens can be reclassified as something else or made composable in a different way, but eventually there's still always that securities law question about access, which is a regulatory question, and the regulated platforms will then have to comply with whatever their jurisdiction imposes on them. So to me, the most interesting conversation of this actually is issuance, and issuance comes down to the asset owners and the issuers raising funds via this sort of distribution, and that's I think that's where the interesting conversations are, right? Like we have seen the bulk of the activity being done by kind of players like Whittle or Benji with their tokenized money market funds, and it comes down as we continue this conversation over this whole webinar, I will make the case that actually it comes down to the quality of assets which are being put into these RWA token chains. I'll pause there.
Wonderful. Yarden, do you have
Yeah,
something?
I wanted to apologize to you, Pauline, and we promise we'll try to disagree as much as possible. But Rachel, I agree 100%. I have a drawing right here of I call it permissioned islands on public blockchain. Right. So what you said is spot on. It's going to be on public blockchain. I think one layer that is still missing, and people I know are working on it, with full force, is finding the right privacy layers, either within that public blockchain or on top of that, because as you said, it's eventually it's securities, and we cannot have a functioning securities market with all the information, everything publicly available all the time. We do need some privacy layers there. That's a that's missing. The regulatory understanding is largely missing, right? There are a lot of pilots, and some regulators globally are more open to, okay, how do we take this? Our securities laws say if it's a security, there needs to be, a transfer agent and a central deposit.
Not sure if it's on my side or it's Yarden connection.
I think the connection of Jordan.
The laws will adapt in terms of, okay, this can also work. Some laws have, some regulators have adapted. That's another missing layer. But then I agree, it's going to sit on permissioned islands again, because securities laws, regulations, sanctions, to make sure you still need to have some controls over who get it, and how the settlement is done on the blockchain. So that part, I do want to, like, as a lawyer, I want to apologize on that part, because like crypto people hate that, and they're saying like the whole point is permissionlessness and open access, right? But we need to kind of balance the narrative and what the goals that blockchain theoretically allows us to provide, equal opportunities, and why, the 1% still have better opportunities even in this new asset class. It is how it is, and securities laws are, as Rachel said, again, not going to go away. And there will be a lot of, okay, how do we navigate that, and how do we get a lot of that to retail, again, through these regulated intermediaries, right? Which, again, as crypto people, we don't necessarily love them, but they're essential here. Just like, the Nasdaq allows, individuals and retail to get into um, traditional securities, we will need the trading platforms. And to me, to answer your first question, the most important player and who will eventually govern and control this, to me, that's the platform, right? So there would be like DeFi platform elements to this, but most dramatically, more TradFi centralized parties who are regulated, who provide the trading infrastructure and the bridge between the real world asset and the on-chain asset, and provide that assurance to regulators that it's not the Wild West. These platforms would be dedicated RWA platforms, but even more so, I think the traditional crypto exchanges building more and more and more RWA dedicated features and products.
Okay, good. Understand. Martin?
Yeah, for me, I have a little bit different take on this in terms of how do we look at this, because we mostly focus on our clients, right? So we really look from the client side. Like, we work with high net worth individuals who are often very skeptical on everything that has crypto related, right? So everything that has to do with the word crypto or whatever in it is already a new thing, right? So this is the market we are focusing on. That's what also is a really interesting conflict area, right? Because a few years ago they would never be able to interact into anything that has to do with that. But in this new world, it brings opportunities. More and more people get interested. So for us, it's about how do we create this trust for capital to flow in, because trust is what we need there. Like of course, you have a few different players out there who have different incentives, right? Governments want to control things, regulators want to control for the governments to follow the rules, and retail wants to just do their thing, right? So we have there a few pillars who work against each other, and whereas the real spot is to combine these three worlds and to see like how can we use right regulatory framework, the right regulators also to control on this framework, and then to build this trust so the real capital can flow in, because capital follows trust and retail follows attention, right? So if we can combine the attention and the moment of retail to have the trust for the investors with a bigger wallet, so to say, then we can combine these three worlds into something which is really meaningful. And I think that's literally the verge where we are at this stage. That's what we also try to do. We try to explain everything in a way that is kind of high net worth individual proof, because they don't want to hear anything about wallets, scams, all these things. No, they want to just feel trust and have their good experience, because I think we all agree this new age has a lot of opportunities, also yield wise, and I think these ultimately have to be combined to use in our favor, and that's where we currently are focusing a lot. We ourselves did obtain multiple licenses, so we are licensed in the IFC Dubai. We have a full asset management license. These things do cost a lot of money, and they're still not really ready for this fully digital framework. You do have regulators, but it's so hard to comply with all of them and combine them. So this is still building there, but I think we will get there. But the most important thing is to have the trust of the investors.
Mm-hmm. Martin, I'll probably steal one of your phrases here. That institutions they follow trust and retail follows attention. This is very good. I like it, and I like that we all here still in an agreement. Anyways, and maybe different point of view at the one stage, because there's we're in the most interesting conversation happened. Rachel, your idea that settlement will happen on public infrastructure while access and issuance follow different rules, I think shows that this is much more complex than a simple yes or no answer. And thank you for that. That was the idea. Yarden, your point about privacy is a great reminder that blockchain cannot become mainstream if every piece of financial information is visible to everyone, right? I'm talking to different types of institutions, and if privacy is not inside or like within or on top of the blockchain system, they will not even read the email. Martin, your focus on trust, I think, brings us back to reality because investors don't move billions of dollars just because the technology looks exciting. And studies also have shown that trust is still one of the biggest factors in investment decisions, especially for institutional capital. So you are on point here. And it feels like everyone agrees that the future won't be owned by just platforms. Yarden, I know that you mentioned that platform will be responsible, though um, it will be built through a combination of all three and protocols and platforms and governments, because with trust acting as a bridge between them, I think it makes more sense. And maybe that's the biggest takeaway already, because in tokenization, the technology is really important, but confidence in what really gets capital moving is even better. Though, let's talk about big guys. Let's talk about governments. Will governments embrace public blockchain infrastructure or attempt to build closed national systems? I mean, we can also discuss how it can be in terms of hybrid systems. But yeah, would love to hear your thoughts.
Sure,
Rachel.
ladies first. Happy
Yeah.
to go first again.
Let's do it like
So,
this.
at Slay Capital, we actually, because of our kind of previous experience of the team, do speak to sovereigns and quasi-sovereigns across Asia and Africa and some other countries as well. And when people ask about like having their own blockchain, especially from the government, actually when you dig a little bit deeper into the conversation, what they're most concerned about probably are three elements, right? One is kind of their monetary sovereignty when they're thinking about having their own local currency, stablecoin or CBBC. They want to have visibility and kind of transparency over the tax and capital flows. But I think the third thing that governs a lot of this is kind of investor protection, right? Investor protection for their own local investors and the investors that are coming in to perhaps like engage with the RWD tokenized projects or financing opportunities that they have. So when you actually break this down, they can also realize that they don't need to own their own public blockchain. I mean, sorry, their own closed national system, because in that sense, sometimes that is actually counterproductive to what they're trying to achieve. A lot of them are looking towards RWD tokenization and this tokenization market with the flow of stable coins or kind of stablecoin native kind of investors investing into national projects. And adding a layer of a closed national system is actually counterproductive to that, right? When you are trying to interact with capital that's outside of your nation as well. And why recreate the wheel when there are a lot of public protocols which are already working pretty well, right? Most of the RWD tokenization activity we are seeing will be on Ethereum, right? I mean, that's just how it is. Of course, we're seeing like a lot of other protocols make a lot of inroads as well, like Solana and the other protocols. So actually, when you have that conversation with these finance ministries and like the quasi-sovereigns, the question of owning their own national system becomes less important when you understand what the real necessity they have. And at the end of the day, it's about attracting good quality capital into good quality projects. And it comes down to the question of trust, right? And it's for me, it's a question of structuring these products right to attract the right kind of capital to embed what's off-chain, which are these real assets, onto an on-chain ledger, which is then transparent and composable and seamless. Right? I think it comes down to a structuring question, a product design question, rather than owning the settlement layer. So for me, that's the conversation that we've had. Owning the settlement layer is less important. And more important is to, control the things that we said before, right? Like the access, the KYC, the AML, the kind of due diligencing of the capital that's coming in, having the the data of and the transparency over the capital inflows and outflows, and then having the proper kind of products, which is the issuance question. So that's kind of the conversations and the experience that we've had.
Very good. Love it. Yarden.
I definitely agree. I would add, I would look at it as sort of like the internet and intranet, right? So just like banks and institutions, playing a little bit with their own private blockchains, not very interesting and not anything big, but or anything successful, but on the back end, using a private blockchain for internal use cases, right, is something that is going to happen in the context of RWA. Like one example again that I've been, hearing and talking about with, tech people and regulators and policymakers of potential use cases of the blockchain, like land registry as an internal ledger using blockchain as technology for managing that, or the plumbing in our context again, the plumbing for a stock exchange, right? Nasdaq would not be on Ethereum tomorrow, but in 5, 10, 20 years it would make a lot of sense for their internal systems to settle on the blockchain. It will just be more efficient, and faster and cheaper, right? That does, like, governments are piloting and playing with all sorts of different use cases, including private blockchain. I think like that's not something that, when again we're talking about issuing assets on the blockchain for people to interact with, right? That is not going to scale on private blockchain or localized blockchains, but rather, as Rachel said, like I fully agree, permissioned way on public blockchain for sure.
Okay, Martin.
Yeah, I think currently that there's, of course, a big discussion ongoing in all governments who are active in this field. They are currently deciding actually how do they want to see this new financial system to look like. That's the real discussion. How do they want to see this unfolding? And it's not only that they want to see some crypto transactions or whatever, because that's a small discussion. They really already see that this is the future of finance and how they want to interact with it. That's also very nice what Rachel mentioned there. That's why some are hesitating to build their own, because they know that they will be excluded from the financial system if they only allow their own assets there to be there. Because capital comes mostly from outside. And currently you really see this discussion. It's going in three ways, right? There are governments that want to build a fully closed system only for themselves. They are facing already some problems. The other ones are trying to build a semi privacy layer, which is semi-controlled, like you also see in the internet sometimes happening. Jordan mentioned something really good, which I was also thinking about already before. Like the internet is a perfect example. We're all on the same internet, but in some countries you have different rules. For example, here in the UAE, you have some websites which you cannot access. So there's a semi-control going on here, for example, in these type of things, and you have countries where everything is open, and I think the same will happen in blockchain. There will be countries who are stubborn and want to do their own. There will be countries who are trying to do a semi version of it, and there will be countries who are fully open out there. And I think at the end it will always be a combination of those factors. And what really will come in very big is, I think, the zero knowledge technology for a lot of governments and protocols who will be using the open network, but with the zero knowledge SaaS over it. So the data will be protected. So I think there will be a lot of differences between nations, but let's hope they will collaborate in a smooth way, so to say, like the internet is doing.
Awesome. I think that there's an interesting theme coming through here. Thank you, everyone, for expressing your thoughts. And Rachel, first of all, I like your point that the real goal is attracting good capital to good projects. I will steal that from you. Because if a country builds a system that cannot connect with the rest of the world, it may end up limiting its own opportunities, which is not that smart. Yarden, your comparison with banks also makes a lot of sense. People don't really care what happens in the back end as long as system is secure, efficient, and trusted. And Martin, I think that you agreed with Yarden on the internet example is probably the easiest way to understand it. We all use the same internet, but the country has its own rules, and blockchain could develop it in similar way. And one very important note, zero knowledge technology could also become a very big part of this story by giving governments more privacy while still allowing public infrastructure to do this job. So yeah, sounds like the future is less about building something isolated, like isolated national blockchains, and more about finding the right balance between global connectivity and local regulation and privacy, of course. Um, though moving from governments, let's focus also on platforms. How do you think are tokenization platforms becoming the next generation of financial exchanges, or tokenization platforms right now is something else? Rachel?
Okay, I'll start and I will probably have the most contrarian view, and I'm going to say no, right? And I'm going to say something that's probably um a little bit rude as well, but I think actually a lot of these tokenization platforms, which are standalone, are structurally doomed. Right, and I'll explain why. If you look at how many platforms there are floating around the world now, not all of them are going to become securitized. Securitized is a success story. They just IPO it. They have lots of liquidity, lots of distribution. But there's something like 167. I mean, I looked it up. There are something like 167 separate tokenization platforms, all acting as their own siloed pools of liquidity. If you divide what's kind of like what the number we often point to, which is like 31 billion of RWA tokens, if you exclude all the stablecoin that's out there, divided by these 167 platforms, that's 200 million each on average on each platform. That's not a venue, right? That is a very subscale localized kind of matching engine, which is not going to have sustainability. So that is my very honest view, and I come to this view also having been the CEO of a tokenized exchange platform. I think where the future is still in my thesis is that it comes down to the right kind of products. If you want to look at the biggest kind of success story in RWD tokenization, well, it is the Buidel money market fund, right? What they've done right is that they've made sure that they had a right product, and then they made sure that it was kind of piped, able to be piped to various venues, and composable also as collateral on various kinds of lending protocols, right? So the issue always comes down to good quality products and then enough distribution. Tokenization platforms, as they are set up now, are too siloed. A lot of them have their own private permission blockchains, which, as we discussed earlier, the age of that is over, right? If you have a combination of that, and the thing is, it's a chicken and egg thing, right? Investors are not going to come unless there are good quality products to buy, and issuers are not going to list unless they're investors. And if you have such a fragmented market of like these 167 different platforms doing their own thing, trying to tokenize, and I think some of them still don't understand that just because you tokenize something does not mean that it's a magic pill that makes your thing fly off the shelf. Right? At the end of the day, it still comes down to good quality product, good product structuring, a robust legal frameworks around it, the proper kind of legal wrapper, and the right sort of linkage between what is off chain, which is the real world asset, and what is on chain. So I think a lot of platforms maybe have misunderstood that. They end up with subpar quality assets just because I guess that's how the fragmentation of the market has gone. And I mean, some of them will end up surviving and become the next securitized or another securitized. But I think because of the siloed nature of these tokenization platforms, a lot of them built on the wrong infrastructure, um, my very contrarian view is that no, they are not going to become the next generation of financial exchanges. I think what actually will make a difference in this space are uh, are adult run, I call it platforms or houses, which are structuring the right kind of products and putting them in the right kind of distribution venues. But again, there's no point distributing nonsense. You have to distribute the right kind of product. So of course, I would like to think that Slay Capital is built for that exact purpose, where we're going to put good quality products, which clients actually want, which was Martin's point. The capital only flows where there's trust, and there's trust only going to be if it's a good quality product. So that's my thesis, right? I think the kind of tokenization landscape will look very different. Already, it's starting to look very different. Venues like the New York Stock Exchange and Nasdaq already have their own tokenized equity kind of projects. The large banks, Goldman's, all these large bulge bracket banks and all the banks in the world already starting to have their own tokenized products, right? So I think the RWA tokenization space is going to look very different. And as players in this RWA tokenization space, it's important to be an adult and make sure you have the right quality product put into the right quality distribution. So again, good quality capital for good quality products.
I again have to agree on both. Like these are my words that I use all the time: the chicken and egg situation, the liquidity versus asset quality, and where do you put your asset on? Like if you've decided you wanted to tokenize, and the fact that if anything can be tokenized does not mean that everything should be tokenized, right? It's exactly that. It's not magic powder. It doesn't make a lousy asset or a bad product work brilliantly and make you millions. That's not how it works. Let's assume we're talking about assets that are worth tokenizing and that have, you know, demand or market potential, right? Otherwise, we're just, we can just throw the baby with bathwater, and 90% of crypto is bullshit. We're still like we're here for the 10%, right? So let's assume we're talking about quality projects and actual value, right? Rachel, you have like two separate elements in what you talked about. You separated the platform, like the launcher, from the exchange, right? Because we're not yet in a world where I can push three buttons. Maybe that's coming. That's what for, right? I push three buttons and I issue whatever asset I want, right? I need to go with someone with a regulated issuer, or someone to take me through the process on the tech, on the regulatory, on the legal, on the integration, on the liquidity, everything else. The platforms we have today bundle that together with the secondary exchange, secondary trading, right? Which makes a lot of sense because, as you said, you can launch the perfect product but end up in a dry well with no liquidity, and then you're stuck, right? So today, these two things go together. You go and tokenize on a platform, on a launching platform that also tells you then like you will have liquidity here later, right? And then these are the siloed liquidity pools that you mentioned, which is the main blocker right now for mass. Not talking about institutions. Franklin Templeton does not need a platform for liquidity. They have their own liquidity, right? But for more adoption and more projects and more things to go, like smaller scale projects to go to be tokenized, we need to go to where liquidity is, right? So maybe you're right, and the tokenization platform will disconnect entirely from the secondary market, right? You can tokenize here, tokenize there, and you end up in the same kind of liquidity pools on the secondary markets, right? They can all end up trading on Securitize or whatever ends up the RWA Nasdaq. Or there would be some kind of inter liquidity solutions and integration, right? In 2014, you had more crypto exchanges, right? But you could buy Bitcoin off Wobby and then take it away and put it on Binance and enjoy the liquidity there, right? There's consolidation of less and bigger platforms, on the one hand. I think that is also something that, yeah, a lot of platforms will rise and fall and fail and be bought and be integrated into bigger player. I think there is going to be concentration. It's going to be the big players. You see Robinhood, what they're doing now in the RWA. I think the existing crypto exchanges will be the largest players eventually in this, in the secondary trading. But I think also interconnectivity and composability of liquidity and secondary trading. I think that's a huge unlock.
I think what you just mentioned was very interesting. There, I see a lot of possibilities also for interconnectivity and all these things. It's a pretty hard question to say like if it's going to be bigger or not bigger, because in volume wise, I do really think that RWA platforms in general do have a way bigger market to come than crypto exchanges currently. Why? Simply because if real institutional capital flows in, and there will be more and more incoming, they will just vanish all the volume in crypto by like this, because the volume is way and way higher. So if you would look at that like that, yes, they might become bigger. But I think we actually have to stop judging tokenization companies with the current crypto rules and metrics, because it doesn't make sense. An RWA project or an RWA platform is way different than current crypto is structured, so to say. And we have seen this from our own experience within our group. We were very early to tokenize real estate. We were one of the first out there to so years ago already. We were way too early, as Jaden already mentioned. Like you can be too early also, and if you're too early, you will lose momentum. So we started with investments which were from €100 onwards, right? We thought this is an amazing idea. We include everyone to be able to invest in real estate. At the end, you are funding a villa of 5 million with 1,000 people, which gives a lot of compliance issues, which gives a lot of issues in general. 1,000 people asking questions to the customer service desk. At the end, it did not work. And one big thing actually is also the retail, which came in, was kind of interested, but does not bring the capital. So we are funding a small amount there with a lot of people, which brings a lot of problems for actually a small allocation. Since then, we shifted. We hired the targets from the minimum investment from 1,000 to 100,000, which is 100 times more, and our volumes start to rise like crazy. We funded like with a few people. We were funding the real estate. We scaled over 100 million there in AUM like rapidly, just because we are focusing on the right people. And it's not. This is something which is very common in tokenization. Indeed, focusing on the wrong people. Yes, you can put that a regulatory framework. Yes, you can build a nice platform, but indeed the capital only comes when there is interest from the people. And if you're not focusing on the right things there, and that's also, Rachel, why I think we should catch up another time to see, because we have a lot of similarities there. We were focusing firstly on the wrong people. When we start focusing on the right people, money flow in. And this is where I do see a lot of still problems with RWA platforms, and some come to me to ask for help or whatever. They're tokenizing gold, for example, and they're targeting retail. Yes, you can focus on gold and have people invest from emerging markets to secure some wealth, of course, but you will see volumes of 500, 1,000 per person, which are targeting 3 to 5% a year. Or real estate, it's very normal to have 10% yield, which is actually high for real estate. That means if you invest 1,000, you'll end up with $100 in yield excluding costs and everything at the end of the year, which you have to lock it for 1 year. Whilst retail wants to make a 10x or a 5x in crypto, DeFi, with gambling or whatever. Whilst if you allocate 1 million and you can earn 100K, that's a significant pile of money, which is worth the wait and also worth doing the due diligence. So there are almost no questions asked from high net worth individuals about these investments, because they did this before. They knew how these investments would work. Retail is asking a lot of questions. So if we start focusing on the smaller investors, no, the tokenization platforms will never get bigger than the exchanges, because the exchanges simply have more to give what the retail wants. They want gambling. They want fast investments, fast trading. Exchanges are way better for that. But if you talking about real capital flowing in the way of a tokenization company or a platform, then the volumes can be way bigger. But yeah, it's just which metrics are you gonna measure with?
I
I
agree.
if I may just respond to that, Martin, you're obviously 100% right. To get real growth and real scale, we need the institution, we need the institutional money, we need the big tickets. But it's hard for me to hear, because that's so pessimistic about everything, everything that crypto is and everything that crypto has been for the past, decade plus. Both can exist, and you go to crypto conferences, blockchain conferences today, it's not crypto anymore, it's digital assets, right? And everyone is wearing a suit, because that's where the money is, and that's how the industry scales and grows, and that's perfectly fine. And it shouldn't be either or, right? In tokenization, it's more of that, right? It makes, like, there are good reason, not just the rich keeping it close to the chest and not letting the poor people in. Everything related to private credit and money market instruments and whatnot. There's good reason why it's a high ticket game.
Yeah.
There is also the big promise of the blockchain, right? Of democratizing access and the great equalizer and all of that. It's secondary, but it's important. It's still there, like in terms of actual scale and size, it's secondary, but it's still there, and it still will happen. It will probably follow the big tickets and the big money,
Yeah, I
and it
hope
will
so. I
trickle
hope so.
down.
Yeah,
But
I mean,
I
I'd like
always like,
to.
mhm.
Yeah, I agree with Yarden as well. I mean, I hear you, all of us have been in projects where you've tried the retail route. It's really painful, right? You have to talk to like 1,000 people just
It's
to
not for us.
raise $1 million. And I don't think, yeah, I think the time is not there yet. But I think it also comes down to product suitability, right? There will be products which are suitable for retail, which are simple enough for them to understand, but also give them a slice of sitting at the big boys table. Because like I mean, at some level, as a human being, I would like finance to be democratized, right? So that's why this RWD tokenization story has some coherence with me as a human being. But of course, as a business person, it's of course much easier to do the more structured products, the more interesting products, and then going for institutional capital, right? Because a lot of our careers have been built on institutional work rather than retail. But I think there will be a time where perhaps this this market matures a little bit, right? Where you will have more products coming online in this way, but there will be a whole range of better quality products. The problem I feel now is that there's still a lot of like not good quality products which are being sold to retail, which was your point, Martin, that it was going to the wrong attention. The attention was being applied in the wrong way to the wrong people. So then, yeah, so I think it's a matter of a maturity of the market as well, to ensure that there's a whole range of good quality products, from the very simple ones that retail can understand, right? Probably a lower yield because they're not going to be as complex or higher up the risk chain, but it's more suitable for them as well. That's why we have client segmentation rules in most countries where you have retail versus professional or qualified or accredited investors. So yes, a lot of the market now, unfortunately, is still focused more on the qualified professional investor / institutional. That's why we have high net worth clients as well. and not yet the retail. But I think the time will come where I would love for a private credit product which is simple enough for retail to understand, to be able to purchase, because at the end of the day, that's still a huge wallet that's very underserved, who are getting very low interest rates. And these are people, as we move towards a more, I mean, like AI is also changing the way that we earn money, that, people are getting jobs. There are more gig workers that will need to save more as they earn and they spend. And I mean, RW tokenization, especially with yielding products, has a part to play there. So that would be my view on this as well.
I want to quickly give a short thing on that one, because I really think there is an opportunity for retail there, but I just don't think it's in this institutional capital money. But where I do think there is a very big opportunity is for projects that do buyback, etc. So you will see, like if you compare it to the dot-com bubble, so to say, like years ago, 90% has vanished, right? So the 10% that stayed are now the biggest companies in the world, right? So I do believe that something similar can happen to crypto, that the most of them, which are not structured right, will indeed collapse. But the real right ones, where people were early in and started believing them, and they were making real money, then the retail can really actually profit from that by being early in them. And then them talking about projects like not only ourselves, but also like Hyperliquid, like these BNB coins, where the real capital comes in another way, but the company is buying back shares and buying back the back tokens. Pendle, you see the same. The token really profits from it, from the institutional capital coming in, and not only from the yield products, no, but from the token itself, by the decisions that the company is making, what to do with the money that comes in from institutional. I think there's the real edge for retail.
I really like this exchange of thoughts of everyone here, because I think it shows that discussion is not about choosing the one side over another. And Yarden, I think that you started this another round of a discussion, and your point is very important, because the original promise of crypto was to open markets to everyone, not just large institutions. And it would be a shame to lose that vision. And Rachel, I also understand your argument that timing and product market fit matter. Maybe it's not time yet, because even great investment can fail if it reaches the wrong audience. Client segmentation, by the way, exists for that reason. And in finance, the right product has to meet the right behavior. And Martin, I think that your view brings the whole conversation together, because retail and institutional investors don't have to compete. They just play different roles in the same ecosystem, but different kind of a sandboxes, maybe.
Exactly.
So yeah, it feels like the strongest tokenized markets will be the ones that will create space for both groups, instead of asking one to replace the other, something like this. But on this note, I wanted to ask a follow-up question on inequality, and is it possible to solve inequality? But I think that throughout the second round of discussion, we kind of answered that. So it's time to wrap up the session, and I would love to express a huge thank you to everyone. If you have any thoughts, any advices to all the viewers who are seeing this or who will see this in a record or listen on Spotify, by the way, everyone, we're available on Spotify as well. Feel free to say some final words, Rachel.
So I think I will come back to a point, right, that this RWA tokenization space only works if there's good quality products. And I think good quality products for me is defined as proper product design with proper pricing, with legal robustness in the structuring of it. And one important thing is within this RWA space is to ensure that the what lives off chain is very much linked to what's on chain. So if you're telling people that they have legal or beneficial rights to an asset that's off chain in the real world, then the legal product needs to fulfill that. Because what we've seen in the early days of this is that you have RWA tokens, which are claiming to give investors rights, which they do not have. And I think that's a problem that is easily solved with proper discipline of structuring product design and product pricing. So that would be my final takeaway on this.
Yeah, thanks, Rachel. You're pitching me at the right spot. Is like putting on my lawyer cap for a second. I wanted to say the exact same thing. Repeat that not everything that can be tokenized should be tokenized. Consider if it even makes sense and if it's the right path to go. Liquidity is king, especially in these early days. You need to build it in such a way that it will fall where liquidity sits, or you expect it to sit in the short term. Otherwise, it will fail, even if it's the best product out there. And Rachel's point is the most important for from our perspective. The regulatory side will continue to, like, regulations exist. It's not that they coming and Clarity Act will bring clarity and then rules will apply. Rules already apply. Traditional securities laws, traditional commodities, financial instrument trading laws exist and apply. The fact that it's on chain does not make them go away. You need to do the offering and build a platform, if you're building the platform, in line with existing and with a view of future upcoming regulations. But also the structure of the entity or the contract or the legal form that controls the asset. And RWAs are by nature bridged between the real world onto the chain. How that is done, there's a legal layer that in the early days people tend to disregard entirely. Right now they're trying to, some are trying to get it right, some are trying to do it as quick and cheaply as possible. It's not a cheap process, it's not an easy process, but you need to get it right because you cannot go back and fix it, and then the best product fails.
Yeah, I think great points, and I can only agree with them. But I think in general, to summarize it, I think the last 10 years we were only busy in crypto to prove that blockchain works and that our technology works, that everything works. I think this point is now clear. We are proven already that works. Technology is there; it will not vanish. So the next decade will only be about proving that businesses also work on cryptocurrencies and businesses also work on the blockchain, that we can make real revenue, that we can make real customers, that we can we can comply with the regulatory framework. And I think then that's the sweet point where we have real growth, and we'll get into the next phase of the real harvesting, so to say, because I think all the old discussions are already made, and now it's time to really capture that momentum, because it's coming there. And I think then it's just time to share also with the ecosystem, so to say. So I think that's the most important thing for what's coming.
Awesome. Well, that brings us to the end of today's panel. I will say it again. Thank you thank you to your speakers for bright-minded thoughts. I feel very inspired. Maybe I will write a whole article after our today's panel on Twitter or LinkedIn. And I have all the notes in my phone here from each of you. So be ready. I will take all of you as well. And I think that one thing is pretty clear, that the tokenized economy is no longer a conversation about the future. It's already being built, and we heard different opinions on the role of governments and platforms, public blockchain networks, but also a shared belief that collaboration will matter just as much as a competition. This is what I heard, at least. And there are still plenty of open questions, and honestly, that makes this space so exciting to follow. Again, big thank you to Martin, to Rachel, to Yarden for sharing your knowledge and insights with us today. Thank you as well to everyone here at RW Week who joined us as listeners or viewers. And yeah, it's been Polly Speaks, and I hope you enjoy the rest of the day, the week, and we will see you on the next panel. Thank you.
Thank
Bye.
you all. Bye bye.